welcome to the Business Standard Morning Show. I'm Nazia Iqbal. Let's take a look at the stories for the day. There's a crucial, albeit simple, missing ingredient that is putting a growing number of public companies in a tight spot with their investors. Let's delve into the details and figure out what companies can do to remedy this situation.
India Inc.'s boards and managements would do well to align their agendas with the broader interest of all their shareholders. In particular, institutional investors, backed by recommendations from proxy advisory firms, have brought corporate governance issues to the center stage. Recently, PNB Housing Finance dropped its plans for a preferential issue of equity shares to raise Rs 4,000 crore from a group of investors led by Carlyle. The plan ran into controversy after a proxy advisory firm raised objections. Subsequently, the deal was halted by SEBI. Consider also the case involving Reliance. In July, Yasir Al Rumayyan, the chairman of Aramco and the governor of Saudi Arabia's sovereign wealth fund, was appointed as an independent director on the Reliance Industries board. The appointment recently came up for shareholder vote, and the voting process was slated to end on October 19. Based on proxy advisory firm Glass Lewis's recommendations, the California State Teachers Retirement System had said that it would vote against Al Rumayyan's appointment. Companies such as Jindal Steel and Power, Phenolics Cables, and Z Entertainment Enterprises Limited, among others, have also come under the lens of proxy advisory firms in recent times. Clearly, India's corporate governance landscape has changed in recent years, especially with proxy advisory firms weighing in on more and more instances. But what explains this change, and how can companies cope with what lies ahead?
How companies should react to it, they have to kind of wake up to the fact that there's a new reality which is there. I go back about 5, 7, 8 years and we look at how were institutional shareholders voting. There was about 10% vote, 90% was abstain. If we look at more recent data, it would be about 85-90% of the shares are getting voted about. The remainder 10 to 15% is abstain. So therefore, investors are having a point of view and they're expressing this point of view through their vote rather than meet up with companies, meet up with managements and say that, look, these are some of the areas where it's an area of concern. Even there, I'd like to say that investors used to tiptoe around issues rather than be a little bit vocal about it. Investors are much more vocal. The second thing which we have when we talk to investors is that often what is the issue which they're confronting? They're finding that there's not enough clarity which is being provided on the resolutions. And therefore, they're saying that, look, if the company intends to do something, they might as well be clear about what is it that they want to do. An example being sometimes they have a resolution for fundraising. It could be a little bit of debt, it could be equity, it could be QIP, it could be GDR, ADR, whatever it be. Now, I understand that companies want to be a little bit opportunistic, but it may be appropriate for the company to say that, look, we have a target debt equity ratio. And if we kind of steer away from this ratio for a brief while, we're going to come back and bring it back to what we believe is the appropriate ratio for our business. Now, in the absence of that, and you just say, look, I want to raise money, it could lead to a dilution of about 20-25%, and investors could get quite agitated about it and vote against the resolution. We looked at data for last year. Institutional shareholders supported 97% of the resolutions or voted for in 97% of the cases when resolutions were presented. So they're also a minuscule amount, and those are the ones where they need to focus on. Which are these resolutions? These tend to be, you can't say there's any one. They tend to be across, whether it is director appointment, compensation, ESOP resolutions, related party transactions, what have you. But they all come about because there isn't sufficient clarity which the companies are providing.
Let's be clear. The majority of resolutions still get the nod from shareholders without any contest. But even the minuscule number of resolutions that make the news for the wrong reasons point to the coming of significant changes in the years ahead.
There are various factors which are changing the which are changing the corporate governance landscape in the country. And I think it is just the beginning. Maybe 2-3 years down the line, you will feel or you will not be able to see that, oh, that was the governance position in 2010 and what we have come. So I think I'm very hopeful in another 2-3 years, the overall governance of the listed company would see a sea change.
Companies also need to appreciate how and why things have changed in the past decade.
I would say that in the last a decade or maybe 9 years, things have changed a lot in India, and a lot of credit goes to regulations which have been framed by Ministry of Corporate Affairs in the form of Companies Act 2013, SEBI regulation in the form of LODR, and also very important by all the regulators, SEBI, PFRDA and IRDA, in making stewardship code and making voting mandatory. Not only that, SEBI has gone one step further and said abstain is not an option anymore and you got to vote. This together with the revolutionary change that is e-voting has made a lot of difference, because participation of institutional investors in the voting has improved considerably for these reasons.
The message being thrown up by the increasing instances of shareholder activism is clear. In a public company, promoters and management need to take the investors along with them. Most importantly, the first step India Inc. should take is to provide more clarity to investors going ahead.
HCL Technology reported a 4% rise in profit sequentially in its Q2 results and kept the forecast for the current financial year constant. The company's products and platforms business revenue fell 5.5% year-on-year. In an interview with Business Standard's Neha Alawadi, its CEO and MD C Vijayakumar spoke about the way forward and the demand scenario for HCL Tech's business.
The first thing that I wanted to ask CVK was that sort of larger picture that you see around products and platforms, and where do you see the business headed?
So, Neha, the products and platform business is 12% of our overall portfolio. 88% of our portfolio is services, which has grown phenomenally well, 5.2% constant currency growth, and pretty impressive year-on-year growth numbers as well. On the product business, it's a seasonally a weak quarter for the product business, and some deals which were to happen in this last quarter slipped into the December quarter. Except for that, we continue to remain very positive of the products that we've invested. A lot of them have been modernized. We have launched Commerce, Unica, and many other products on various hyperscaler platforms. So all the investments that we are making is resonating well with the customers, the new product features and functionality. This year, we said we will be a flat to 1% growth. And given the overall progress that we made on the product business, we remain confident of a good trajectory going forward.
But by when do you see, these issues smoothing out? Is there a timeline that you have in mind? And also, it's been a while since the IBM products acquisition. Do you have something similar in the pipeline? Are you looking at any other big bang acquisitions?
No, we are not looking at any big bang acquisition. Today, there is so much momentum on the organic business. So I think we are better off as a strategy to focus and execute to the demand that the market is presenting to us, rather than looking at any major acquisitions. We can always have small tuck-ins to expand in a geography or in a capability area. So you'll only see the smaller ones. You won't see any big bang
acquisition.
Also, your peers, a lot of them seem to have raised their guidance. Not just Indian service providers, but also people who are those who are based outside of the country. But your guidance is also constant. You've not changed your guidance.
Yeah, actually, it's a little bit of a conceptual question. In fact, if you see the last 5 years, we gave precise guidance. We met guidance every one of the 5 years, both on revenue and margins. I think moving forward, we think trying to kind of provide a broad range is the right approach rather than kind of putting a very precise number and then really chasing that every quarter. I think it's not the best use of the management time. Providing a broad picture, and we've always delivered to our guidance. And we're going to give you leading indicators like the total booking numbers, the net hiring number of people that we're adding. All of this should give you some kind of leading indicators from an overall growth perspective. So we are really not keen to give a very precise guidance.
Attrition has been an issue, I think, across the board. Do you think you're on track to, are any of these problems affecting your supply side, given the demand that you're seeing right now?
Yes, attrition has picked up in the last quarter. But it's still fairly below many other industry players. So we are quite happy about that. HCL was rated as the number one professional services firm globally in Forbes Best Employer list. So it's an amazing recognition, not only the India heritage providers, but number of global players. HCL came on top on this Best Employer list. So our employee value proposition is very strong. We are really not looking at our engagement with our talent on a short-term basis. We are looking at a much more long-term career, really enabling them to scale up to deliver more and more high-value work. And I think that is resonating well. And also, we took tremendous care of our employees during the most difficult phases of COVID. I think all of that is making it very rewarding for people to continue with HCL to pursue long-term careers.
And how is the demand environment changing because of the pandemic? Is there a difference in the way deals are structured?
It's not completely new, but now what happens is one is the whole vendor consolidation theme. There are a few vendors, customers who are high quality vendors, they want to consolidate around them. Some of the wins that we had last quarter was related to that. The second piece is do the infrastructure and application operations as well as modernization of infrastructure and application and really migrate them to cloud. So these are the two major themes. And sometimes both the outsourcing and the modernization gets combined into an overall deal. And that's what we've seen in several of the large wins that we've had in the past 6 months.
And also you've expanded into a bunch of new geographies. I remember you've mentioned this in the last few quarters whenever we've spoken. So this is kind of, bringing it all to fruition. But what is the larger strategy in these geographic markets?
No, I think there are two. One is, of course, there is a core market, which is US, UK, Nordics, and a few more English-speaking countries. That's the core market for us where we have strong market presence. So we will want to sustain and consolidate and grow in those markets. There are what we call as 5 focus countries: Germany, France, Australia, Canada, and Japan, where the market size is very big and our presence is lower than what the market opportunity is. So we are stepping up our presence by more local leadership, investing in local solutions and talent to really work with our clients, both from delivery and solution perspective. And then there are some geographies where we are just not present, like South Korea, Brazil, and some of these geographies where we are investing. And Mexico, we were present, but we are stepping up.
And our margins and, is there enough sort of leeway or enough opportunity in these geographies that you're entering?
Yeah, you have to be selective. You can't go after all the business. You have to be selective. And the value proposition needs to be strong to deliver a reasonable margin. But early days in these geographies, so maybe we will invest for some time, and as the scale increases, margins will automatically play out.
How are you seeing deal ramp-ups? You mentioned some got postponed into the current quarter.
So that's only
But
the BNP segment. It's not really a ramp up. In software business, there is software subscription and the new license. And new license, when it is sold, a big part of it gets recognized in the same quarter. So that's got slipped into the next quarter from a closure of the sale perspective.
But given the softness in products and platforms, do you think your guidance is realistic and you'll be able to meet the forecast that you've made for this year?
Yes, we are quite confident, even though there may be slightly lower revenue from the product business. I think the services business will make up for it, and we are confident of the double digit.
Great. Thank you so much, and have a good day.
Thank you, Neha. Have a good day.
The markets snapped their 7-day winning streak yesterday, dragged by FMCG, metals, and realty stocks. Earlier in the day, the BSE Sensex had breached the 62,000 level in intraday deals. Are more gains in store for the frontline indices, or is a meaningful correction about to set in? Let's find out.
Dalal Street ended its longest winning streak in nearly 10 months as benchmark indices closed lower yesterday, after trading higher for most part of the day. FMCG, metals and realty witnessed aggressive profit taking while IT stocks managed to hold ground. The BSE Sensex scaled a fresh peak of 62,245 but ended 50 points lower at 61,716 as profit booking set in at higher levels. The NSE Nifty 50 topped the 18,600 level in the intraday trade and eventually settled with a loss of 58 points at 18,419. If the technical charts are to be believed, there is more room for an upside in the frontline indices. Let's go to Avdut Bakkar for insights.
The BSE Sensex crossed 62,000 level and continues to trade with extreme bullishness. Similarly, Nifty 50 touched 18,600 and maintained the positive bias. The momentum for both the indices, Sensex and Nifty, continues to be in an upward direction. Sensex is heading towards 63,500 levels, whereas Nifty is heading towards 19,000 levels from a short-term perspective. Here on, any selling pressure or profit booking may see addition of new long, as there aren't any major signals that could show a negative downside.
That said, the focus in the immediate term may shift towards mid-cap and small-cap stocks, with more companies announcing their September quarter results. The results that are to be announced today are Havells India, Jubilant Foodworks, Just Dial, L&T Housing Finance, Angel Broking, Taj GVK Hotels, Shoppers Stop and Tata Communications.
If you're thinking of buying new furniture, kitchen appliances, or gadgets, and funds are an obstacle, there are many schemes in the market that gives you an option to make purchases via loans or credit cards. One such scheme is Buy Now, Pay Later, which is now regarded as an alternative to credit cards. But what is the scheme and how does it work? And is it better than credit cards? Let's find out.
There isn't any such thing as a free lunch. We have heard this expression so many times from our parents, friends, and well-wishers. But we do still get excited by many offers or services claiming exactly the same: free lunches. While these offers and services provide appetizing convenience to consumers, they also leave some with regrets. Now, you must have heard about the Buy Now, Pay Later or BNPL scheme. In short, BNPL is a financing option that allows you to make purchases and pay for them later with an interest-free period. The BNPL scheme has an interest-free deferred payment option. It allows you to make purchases during online checkout or offline transactions. There is no upfront payment and an option to repay within a stipulated period. Different payment options are available. On selecting BNPL, you see alternatives ranging from one-shot payment after 30 days to 3 to 12-month equated monthly installments or EMI schemes. It may also be possible to convert the one-shot payment into EMIs at a later date. Consumers have to go through a one-time Know Your Customer process. Several players like Lazy Pay, Capital Float, and Zest Money offer such schemes. BNPL has several payment options, such as one-shot payment after 30 days, 3 to 12-month EMI schemes, and the option to convert one-shot payment into EMIs at a later date. A one-time KYC is mandatory in this scheme. Now let us talk about the fee structure. If you don't pay by the due date, you will have to pay a late fee that can range from 0 to 500 rupees, depending on the principal amount. If you go for one-shot repayment, your bill could get generated on the 1st or 16th of the month. If you are paying through auto pay and it bounces, you may have to pay a few hundred rupees per bill cycle. For the EMI option, overdue charges are calculated on a per day basis. Suppose that your installment is rupees 5,000 and your interest rate is 26%. You will have to pay rupees 3.56 for each day of delay. Now, the most important question that comes to mind is this a better option than a credit card? And which is the most cost-effective payment option? Usually, only customers with stable incomes and considerable credit history are offered a credit card. On the other hand, even youngsters without a long credit history and gig workers whose income are irregular stand a chance to avail of BNPL. BNPL generally offers you credit for 15 to 45 days, after which the interest rate charged ranges from 0 to 26% annually. Credit cards offer you 30 to 40 days of credit, after which they charge interest in the range of 24 to 48%. Some BNPL plans send a hard query to the bureau each time you opt for them. So this can negatively impact your credit score. So before selecting a BNPL plan, it is always advisable to find out about the credit check requirement. Now let us go to Bindisha Sarang to understand some important things that we should keep in mind before selecting the BNPL option.
3 things to keep in mind when you're buying now and paying later. Simple. 1. The chances of overspending can be higher in case of BNPL if you're not careful. Second is that if you have more than one BNPL relationship, you will have multiple due dates to be mindful of. Third, you should be very careful of tracking your spend so that you don't end up buying more than what you're comfortable repaying. And the last thing that you need to remember is that if you're not careful, you will end up in a debt trap, and late payment fees can quickly add to that burden if you're not mindful of your due dates. So these are the few things that you need to keep in mind when you're going for the BNPL scheme.
So there is no doubt that BNPL is quick and easy to sign up. It is also easy to open multiple accounts. But there is a chance that you could end up overspending. So track your spends closely.
That's all we have for you today. We will be back tomorrow with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.